Your market news now. Global stocks are mixed ahead of this week's U.S. inflation reading and a crucial European Central Bank meeting. Expectations for U.S. rate cuts have been receding this year on the back of robust economic data and sticky inflation readings. Meanwhile, industrial metal prices extended their gains amid expectations of a worldwide manufacturing rebound. An index of global commodities prices has advanced 12% this year. It's outpaced the S&P 500's 9.1% climb. We're also seeing copper and oil gaining more than 10 and 17% respectively. Even gold is posting fresh records. To give us perspective on those dynamics, we are joined by Makwe Masilela from Makwe Fund Managers. Makwe, thank you so much for your time. Before we even talk about commodities, let's talk about how markets are faring so far since the start of Q2.
Markets are looking for new themes. That is just ahead of that U.S. inflation number that's supposed to be released tomorrow. And we've seen that the yield, especially on the 10-year, they were just a touch away from that psychologically important 4.5% level. And I think markets are starting to be comfortable with the fact that most probably will get at least 2 rate cuts this year. So we also have the ECB coming on Thursday, and markets are saying maybe the guys will have to do more work to prepare us for a possible initial rate cut come the 6th of June.
Let's talk about those rate cut repricings that we've seen. We started the year with an expectation of 6 or maybe 7. It's come down to 2. Some people are even expecting no rate cuts. What do you make of those changes?
It just shows you that sometimes we unfortunately we had it wrong, because now this is the resilience of the economies. And here we are talking about the economies which are more than 60% driven by consumer demand. And we've seen everything that's got to do with consumers, including manufacturing, has been very resilient. And we can even see another testimony is when you look into the bank results, that these guys, unfortunately, they have to increase their credit impairments, telling you that these economies have been driven by consumers, as much as those consumers are overly indebted, including the likes of credit cards. But as it stands now, markets are convinced that at least we're not going to get any recession. As we are saying, the labor markets, whatever you name it, has been just doing okay. So we just have to be realistic, because these guys, every time they tell us that their decisions will be driven by data. So if you see data doing okay, then you start kicking the can further down the road. That is not going to be happening now. Remember, at some point, we thought March, now June is 50-50. People are now starting to look into July. And yes, as you are saying, it can even maybe probably happen the 4th quarter of this year or next year.
Let's talk commodities for a bit and focus in on the gold price. It's hit an all-time high. Year to date, it's up about 14.8%. What are the reasons behind this move? Have you managed to figure that out? And do you think this move has legs in the short term?
We know that a weaker dollar tends to affect gold prices, but what affects gold prices more is the interest rates in the U.S. Because if interest rates are high, then the opportunity cost of holding gold goes up. So now when you have expectations that interest rates will go down, then it tells you that it's okay for you to hold gold. So hence we've seen that going up. But as well, there have been some serious buying coming from central bankers, especially from the likes of China and India. Not forgetting as well that gold tends to be used as a hedge against geopolitical tensions. With the escalation that we've been seeing in the Middle East, also including the Russia-Ukraine issue, that as well had managed to boost the demand when it comes to safe haven, and gold had managed to benefit from all that.
What is the impact if commodity prices continue to rally as we're currently seeing, especially when we're talking about a central bank where we're now starting to have doubts about whether they're going to actually cut interest rates? What does it do for that inflation fight?
If you look into all commodities, some will know these are industrial commodities, and they will go up because people think the economies will start to do okay. So now it means the input cost of whoever is manufacturing whatever, they will go high. Hence, people are also having this thing that it's okay for central bankers not to move too fast, because with economies doing okay, then most probably inflation will start coming back. Hence, the guys, they want to be convinced that they've managed to win the battle against inflation. But for producers of those commodities, including us, then it's good news for us and also for our currency as well, because higher commodity prices tend to lift the rand as well, and the rand becomes stronger. And South Africa, as we know that we're a net importer, a firmer rand is much better for us because we won't be importing inflation, and that will give at least our Reserve Bank some reasons as well to start considering that they might have to start cutting interest rates. As we are talking now, our inflation is still at elevated levels, and we expect our cuts to happen probably, if we are lucky, fourth quarter of this year, because inflation expectations are still anchored at higher levels.
On Thursday, we've got the ECB meeting, but locally, we've got the listing of We Buy Cars. What are you going to be paying attention to in relation to either We Buy Cars or transaction capital?
Transaction capital, I think, is also already a foregone conclusion, because we know that the guys have sold some of the shares and given them to buy cars. I think they raised almost 152 million out of that, and we buy cars issued some shares as well. I think 40 million shares or so. They managed to just get under 750 million. But all in all here, we are talking shares that will be like in issue 451 million or so at almost 18.75, making their market cap to be around 7.8 billion. And now transaction capital, as we're talking now, the market value of that company is around 7.5 billion. But the good news are those who wanted exposure to the likes of We Buy Cars, they will be able to do that without having to be mixed with other businesses when it comes to transaction capital, because that will just be a pure We Buy Cars business. And most probably people will get to be attracted to that, especially if interest rates will start coming down, hoping that affordability will improve. People will start buying more cars going forward.
All right, Makwe, let's leave it there. Thank you so much for your time. That is Makwe Masilela from Makwe Fund Managers. And he did talk about the We Buy Cars listing on Thursday, but we're also going to be paying attention to the European Central Bank interest rate decision. If, of course, Christine Lagarde does sound dovish, we could see that having an impact on the euro, in the sense that it may hit the euro. But if she does come out a little bit more hawkish, we could see rather the euro having a bit of a jump. Of course, we did see inflation come in at around 2.4%. It's the lowest it's been in about 2 years. So we'll be paying attention to those dynamics.